Hey everyone, welcome back to the channel. So in this video, I'm going to talk about this margin call from a hedge fund that everyone seems to be talking about, how this is affecting the markets, and if I think this is creating any opportunities for long-term investors. Now, this story has been all over the news, how a blow-up at Bill Hwan's hedge fund is rattling markets globally. So what essentially happened is this hedge fund was levered long some bets. They got a margin call, and this forced huge sell-offs in a number of stocks. And in addition, the banks that were backing these hedge funds and offering them leverage also suffered a large loss as a result of this. So shares in some of the world's largest banks plunged in Monday trading. Nomura Holdings and Credit Suisse Group fell more than 14% and said they may face significant losses because of their exposure to wrong way bets by the hedge fund following the forced liquidation of $20 billion in positions linked to the New York-based family office. Now, these declines were triggered by banks such as Goldman Sachs and Morgan Stanley, who sold a large number of shares that are called block trades. So they're billion-dollar blocks of shares that are being traded, and these were massive block trades that were put on. Some of them exceeded $1 billion and hit during normal trading hours, which can have a large impact on stock prices. Now, the reason that this was even allowed to happen is that the hedge fund used derivative contracts called swaps to gain substantial additional leverage that they didn't have to disclose in regulatory filings, since the positions were on the bank's balance sheet, not their own balance sheet. So it's clear that this hedge fund was way over leveraged, even more than what its investors thought, since these swaps don't have to be listed on the disclosures. And then what went wrong was he was forced by the banks to sell 20 billion of shares after some positions moved against him. And then as these bets went wrong, the prime brokers started demanding that the fund provide more collateral in what is called a margin call, and then exercise their right to liquidate his positions to recover the money. And so of course this creates a huge sell-off for the stocks that were affected by this. And so here are some of the stocks that have been the brunt of the selling. We have Viacom, CBS, Discovery, Shopify, and then a number of Chinese companies like Tencent, BIDU, GSX, VipShop. Now, once in a while when there's an event like this and everyone starts panicking, I like to take a look to see if there's any opportunities for a long-term minded investor to take advantage of, to be able to take advantage of times when everyone is panicking. And there are potentially some things to do here. So, I gave you the list of stocks that were potentially affected by this forced selling, which means that no one's going to care about the value of the company. These hedge funds were over leveraged, and as a result of that, they had to sell off these positions no matter what they thought about the companies. And this could potentially give a great opportunity for someone that likes these companies to come in and buy at a discounted price. Now, I gave you the list of some of the companies that were affected. The one that I'm the most familiar with is Viacom CBS. This is a company that I was actually looking at last year when it was trading at under $20 a share. I didn't pull the trigger. Obviously, looking back, that was a mistake as it hit $100 just before this huge sell-off. But I think with this over 50% decline just in a few days, I think this may provide an opportunity for investors. Viacom has a lot going for them. I think they recently started their streaming service, and they do have a lot of media rights that I think are very valuable. Now, with the sell-off, you can see that Viacom's trading at around 11 times earnings, which is cheap compared to the rest of the market. But even with this, I don't know if at these prices I would want to buy Viacom. Even though I think investing at these prices could provide a pretty good return, I always like to have a margin of safety when investing. So now I'm going to take a look at the options chain of Viacom to see if I see any opportunities there. Okay, so here we are on Thinkorswim by TD Ameritrade. Here's the chart of Viacom. Obviously, pretty ugly chart. Fell from over $100 a share. Now we're under 50 in just a few trading days. Now, the thing I want to look at is the options chain for Viacom, because when you have huge sell-offs like this, it results in an increase in volatility, and what that means is the option premiums are going to be inflated. And so even though that's usually bad for people that buy options, it's usually a good time to be a seller of options. So in a situation like this, I would look for places where I could be a seller of options to really be able to take advantage of the situation. So here we are on the options chain. You have all the different expirations. And so like I said, I want to be a seller of options. And now something I've been thinking of doing is selling a cash secured put option for Viacom, because like I said, at $46, Viacom may be a good buy, but I always want to see if I could get a lower price than that. And so by selling a put option, you can choose the price that you would take the shares off someone's hand, and while doing that, you can receive a premium as well. So I went down to the options that are expiring on May 21st, so that's 53 days from now, and I do think there's potentially some interesting opportunities with selling a put option with the $35 strike or the $30 strike. As I've said, you get some pretty good premiums from these. So for example, if you sold the $35 put option, you'd get $100 per contract. Now the thing with these is that if you're just selling a put option and you aren't buying any other options to offset that, all you have is the cash to back it up. What this means is if you sold, say, the $35 put option that expired on May 21st, if on May 21st the share price of Viacom is below $35, you have to buy 100 shares of the stock per contract. Now to be compensated for this, you'd be getting $100 per contract, and so this is something I'm thinking about doing. If you watch my videos, you know I have a good amount of cash that I want to put to use, but I just haven't seen any good opportunities for it. And so something I could potentially do with that is sell some of these put contracts for Viacom. Now, what I like about this is you can choose what price you want to buy. So even though I might not think Viacom is super undervalued at $45 a share, at $35 or $30 a share, I definitely think there's a margin of safety at buying Viacom at those prices. And so if I were to do this, I would sell contracts based on the number of shares I would want to buy, and then I would receive the premium. And then on May 21st, if the share price of Viacom keeps crashing and goes below $35 or $30 a share, I would buy the shares at whatever the price was. But if Viacom stays above the strike prices, all I do is collect the premium, and then I don't have to buy the shares. And so to me, this seems like sort of a win-win situation, because based on probabilities, it's not very likely that these contracts will end up in the money. If you take a look at the delta, which gives you the probability that these will end up in the money, for the $35 strike, it's a 13% chance, and for the $30 strike, it's 6% chance. So very low percent chances that you actually end up being obligated to buy the stock. But again, that's always something you should be prepared to do if you are selling put options. But at the same time, you get to collect a nice premium just for taking on that risk. You could also take a look at different expiration dates. I'm looking at the May expiration just because I think in 53 days, there's a good chance that this margin call will be over. It'll be resolved, even though this price may keep coming down. I think 53 days from now, we'll see the end of the forced selling, and then a lot of investors will come in and buy these stocks back up. So that's why I think there's a pretty good chance that these options would expire out of the money. But even if Viacom did go below $35 or $30 a share, I do think that would be a pretty good place to build a position. Now, the last thing I want to talk about is the potential for this to continue with more hedge funds. There's an article here. Tiger Cub's $20 billion margin call means more hedge fund pain ahead. And what this article is saying is that there's a lot of hedge funds that are positioned just like this one that have this huge margin call. And so what happens if these banks aren't comfortable with that risk anymore and force these hedge funds to sell off some of their leveraged positions? That would mean a lot of forced selling and potentially a lot of sell-offs in individual stocks and maybe even the market as a whole. So this is definitely something to keep an eye on. It could potentially be a catalyst for more of a sell-off ahead. Even though I don't know what's going to happen, it's always good to keep an eye on the risks in the market. So that's all I wanted to talk about for this video. Again, this isn't financial advice, but I'm taking a look at selling put options on Viacom. You could also take a look at any of the other stocks that were affected by this if you like them better. So yeah, let me know down in the comments what you think of this potential trade, if you think it would be a good idea or not, and if you're doing anything yourself. So that's it for now, and I'll see you on the next video.